Insightful value here with a compelling exploration of why Eurazeo stock has slumped and whether the dip may conceal long-term upside for value-minded investors. This review is for informational and educational purposes only, not financial advice. If you find this helpful, subscribe and like. Today's date is July 27th, 2025. Eurazeo SE is a Paris-based investment firm and private equity group managing roughly 36.8 billion euros in assets invested across hundreds of companies globally, including private equity, private debt, real assets, and wealth solutions. From a value perspective, the company looks discounted relative to its strategic progress and asset base. In fiscal year 2024, Eurazeo reported a net loss due to valuation markdowns in its growth and venture portfolio, although fundraising surged and its strategic plan moved forward. The board delivered strong asset rotation with 3.4 billion euros in realizations, a 10% dividend increase to 2.65 euros per share proposed at the annual meeting, and a doubled buyback program totaling 400 million euros. In the first half of 2025, fundraising remained robust. 2.1 billion euros collected, including 1.2 billion euros in private equity and 0.9 billion euros in private debt, and third-party assets under management rose 10% to 27.5 billion euros. Despite these metrics, the stock trades near one-year lows, reflecting skepticism around portfolio fair value adjustments, missed marking expectations in parts of the venture book, and short-term loss visibility. Analysts caution that earnings volatility may persist, while the share price remains range-bound between 62 euros and 69 euros in recent technical setups. From a fundamental standpoint, margins in the asset management arm are solid. Fee-related earnings stood at 150 million euros for 2024, with a margin of about 35%, and operating leverage continues to improve as management fees grow faster than costs. Portfolio net asset value on the balance sheet is approximately 107 to 108 euros per share. The reputable fundraising momentum and planned impact and growth funds reinforce long-run growth prospects. Risks include continued downward revaluations of growth or venture holdings, slower than expected exits, capital market disruptions, and exposure to valuation cycles in private market assets. While the dividend has risen steadily, 10% higher in 2025 versus 2024, future increases depend on profit recovery and exit gains. Why might now be interesting? The current valuation implies pessimism is fully priced in. If asset realizations accelerate, growth funds close targets, and exit multiples recover, share price may re-rate toward fair value. Why not now? If macroeconomic headwinds deepen or portfolio values remain under pressure, the discount may persist or widen. Near-term volatility is likely until visibility improves. In summary, Eurazeo is not faltering. It remains a substantial player in European private markets with disciplined execution, growing fundraising, strong returns on exits, and shareholder returns through dividends and buybacks. For value investors watching for turnaround potential in asset managers with embedded NAV and recovery optionality, it deserves a seat on the radar, but only if you're comfortable with private market cycles and illiquidity horizons. For more deep dives on Eurazeo and other undervalued names, visit InsightfulValue.com, where we simplify complex financial data into clear, actionable insights without jargon. Thanks for watching. Subscribe for value-focused analysis and head to InsightfulValue.com for more coverage.